Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out Quantcha Unlimited, our commission-free stock and option trading offer that includes everything we use here on the web tools for just $99 per month. Now let's jump on in to take a look at where we are with today's portfolio. We've only got four positions open at this time. The primary one, or actually I should say, we've got Carnival where we're bullish. This is moving upward, which is nice. We are hoping to see closer to 58.5 by the end of the week, so we can get those short puts in. In the event that we don't reach that, it's okay because this is part of a stock acquisition strategy that we may or may not hold through on. I say may or may not because as we review it, if we can, it costs us $9 to get assigned, which is not really a big deal, but it might turn out based on the liquidity and the other market circumstances, it might be better off taking this particular position and closing it out manually and then buying stock. Or, part of the reason we were looking at this was because we've got a dividend coming up next week. And so the consideration was potentially to hold stock with that dividend and sell a call against it. Again, the pricing of the dividend and the call and the versus secured put and all that, it's generally going to wash out just because of the put call parity. But again, bullish, moving up. We're happy about that. Facebook's move it barely nudged up today. 165 is our magic number here. We want them to be at or below this in about 4.5 weeks. So right now, this is in good position. We've already started to see a little bit of that theta burn off in our favor here, as we're up about 70 bucks on that trade, and we're going to let that churn down a little bit more. Hopefully, see some continued lack of momentum. I guess would be the way I'd put it. We are bearish on Facebook, but not aggressively bearish, but we are bearish in that we don't anticipate a move up. But part of these bearish trades we have, like Facebook, are to balance out our overall portfolio, because the expectation we have is partly that we don't think the Facebook's going to move up with the market as much as the market moves up, but more importantly, in the event the market drops, we have Facebook in a bearish position to help us capitalize on what we would expect to be an outsized drop in Facebook relative to the market. Next, we've got Microsoft. Microsoft is a very similar position that we have with Carnival in that we've sold a put. We would like to own stock again. They do have the dividend coming up. One difference is that because of the margin requirements that we have for our account here, it is cheaper for us to go with the short put than it is to have a covered call. There's just less margin tied up. You'll notice down here in our asset allocation, we're only allocated at this point, about $2,200 to cover that one short put that we have. That has to do with a fairly complicated process that's used to calculate what your short put requirement is, as opposed to a cash secured put. A cash secured put and a short put are really kind of the same trade, except that when you have a cash secured put, you put the entire cost of acquiring, in this case, 100 shares struck at 108 in margin, which would be $10,800. It's much lower if you get the option clearance with short puts, but of course you're putting yourself at more risk there. But we're treating this for all intents and purposes as a cash secured put, so we're not really gonna leverage up here. We are happy to own 100 shares at 108, especially given that we received $1.81 as credit. So we are up on the trade a little bit there too. And then we've got a Micron trade. This is a trade that is sort of a thorn because the intrinsic value to lose, if we take a look at our options view for the portfolio, it's $900 intrinsically, and we have completely lost all that because we are so deep in the money on this credit call spread that we were bearish, and so we needed it to be at or below 33.5 to get full value for it. So it being above 42 and expiring 3 days means that we're going to take a full loss on this. But the downside, what really is tough here, is if we could close it at $900, we would do that today. And you can see that based on the midpoint pricing, they recognize about $27 that we have in net value for the credit based on the trading, meaning that we're down in the hole $900 intrinsically. But if we were to close the position at the midpoint pricing, we'd be able to get back $27. But because it's so deep in the money, we're not going to see that, and it would cost us about $200 in liquidity right now, meaning that we are on paper, from a market pricing point of view, down over $1,100, although realistically, the most we can lose here is $900 on the trade. And again, that is if we went through the process of closing it out and we didn't pay. If we took a look at closing the book at this point, you can see the debit here $1 debit would be the strike distance, which means that if somebody came along and said, "Hey, I'm willing to buy this trade from you for $1.10," which is the midpoint we're looking at here, it would be a pretty it would be a pretty good trade for you to take on because intrinsically, immediately you'd make a profit. So this is going to bounce around, but the bottom line is this spread here, these are not going to get better for us. So what we will most likely do is, unless we could manage to close out the entire thing for less than $18, which would be the cost of exercising one leg and assigning the other at expiration, we're just going to sit here and let them unwind after the expiration date. And to put it in perspective, that if we sold for $1.02, because we're looking at 9 contracts on each side, $1.02, if we previewed that order, it would cost us $18. So at the end of the day, this being sitting here at that one, what we'll try to do is we'll put an order for one, say good till canceled, and I'm just going to let this sit out there as a net debit, meaning that if somebody comes along and is willing to take this off our hands, we'll save 18 bucks. We have no illusions about making money on this trade. I mean, we're not going to return. So I'm just going to put that good till canceled order in there to sell at $1. It most likely won't fill. Nobody's, it's unlikely somebody's going to come along and bother trading that with us, but we'll put it out there because who knows? Maybe it'll take. Even if we went to $1.01, we might get it, but for now, we'll just let that sit out there as is. There is one trade I was looking at earlier today that I was thinking about getting in on, which is if we go to the screeners, I'll show you if we go to our stock screeners. The only thing I did here is I'm sorting by equity change for the day, and I wanted to see at least good liquidity. I'm looking for a little bit of negative beta, weighted delta for our portfolio, so that even though the market's been moving up and that's been helping us generally, it doesn't go up forever, right? The market, it's going to bounce around, and we don't want to be dependent on the market. So McDermott's got earnings coming up. We're not going to touch them, but Teva just announced, and there, as you can see, it didn't go very well. And so I think what we might do is we'll probably get on a trade here. We'll look for a bearish opportunity to grab some of that volatility in the near term as a credit trade. So if we can go to let's say we go out to the March expiration here. Now, they don't have any dividend or anything else as far as I recall that we have to really be concerned about. So yeah, and that would be priced in already to the view. Now, we're looking at a neutral view right now. They provided us, or actually I was looking at a bearish view earlier. It retained the last view. I'm going to reset this to the current pricing for moderately bearish and apply it. And we're using a $500 budget here. That's a relatively small portion of our portfolio. I think it's about 2%. So we're looking at that, and I'm going to notch our options up to use all the options available. And so it's going to churn through now. And you'll notice that these trades they're not really there's not huge potential here. And part of the reason for that, when you go with what we have here, which is basically a 50-50 trade, right? This is a trade that we've aligned that says we want to be profitable as long as the stock doesn't go up from here. So we're pretty much accounting for the risk-free return in that that's a zero volatility movement upward. So that's sort of like the base return you have to expect based on the interest rate right now. From that down to a -1 vol movement, that pricing here means that we're effectively, and we're knocking out the range bound strategy. So we're saying, hey, we just want to flip a coin here. And I'm using that not from a gambling sense, but more saying we think that we have an edge here in the market, expecting this to go down from its current point over the next, what looks like 4 weeks between now and this expiration. Now, what we'd expect to see are two things. One is, in a completely perfect parity world, we would see a return potential of 100%, which would be that there's a 50-50 chance, therefore we have a 2-to-1 benefit, or rather we have a 1 in 2 chance of it going down versus going up. And so it would be like a binary event. Like we either make our money on it or we lose it, and we should be evenly sided. Now, of course, in the options world, that doesn't happen. First of all, there's going to be a liquidity cost. So you'll never, you generally won't see a 100% return on a trade you're taking that's, if you're taking a pure bullish or bearish view on it. You can obviously get that by tweaking with your model and your options and stuff. But for our sake, we want to say if this goes down, we want to gain money from it. Now, the other thing that's key is that when the potential is relatively low, that's indicative of, for a trade like this that has the best average near 60%, when it's low, that sort of tells you that the market is skewed a little bit in favor of it, expecting it to continue to drop. Now, that continued drop, the reason that comes into play here is because people are probably buying puts and they're selling calls and they're doing something. And while there might not be a massive shift in the skew, but you can see there is a little subtle shift in the skews here where people are at this point. It looks like they're more inclined to sell the calls that are out of the money here, and then either buy the puts. As you get a little bit of divergence there for this expiration, and you see they're pretty closely aligned as you come in through the in the money, or below the money, I should say, below that strike price. So we're kind of getting on with a momentum trade here, where we are sort of attaching ourselves to the expected movement of the underlying. So you'll notice that we also have pretty good parity in that the bear call spread and the bear put spread at the same strikes is giving us the same return profile. So we'll come through and we'll review this trade here. Now we'll see the average probable return is a little bit negative right now. And that just tells us that if you were to take this full term profit and loss chart and marry it to the implied distribution based on the current volatility at the term, you'd expect to see something like this, which shows us that, hey, the big profit potential is around 17, the big loss potential is around 19, and as you get further out, you drift off. This is especially useful in trades where you have ratio spreads or anything where you have a big potential for return up here or down here, and it looks great on a chart like this, but when you apply the probability and the statistics to it, it's very unlikely to actually see a movement up here or down here based on the market's expectations. The other thing you can do is, if you're curious about liquidity, and in this case, we actually have all the options, have pretty good liquidity here. If we click the customize, we can see the spread. We've got a penny spread for the 17 call and about 3 cents. Within 5 cents we consider to be good liquidity, so because you can't really say like 20 cents versus 23. So that is, this looks like a fairly liquid stock that we should be able to get in and out of the options for. And so we're just going to choose to model it in our book. And now we're into the power tools where we can really drill in and decide what we want to see with the details on it. The main thing that I want to focus on is this number here. If we open this position, we're adding a negative 13-ish beta weighted delta, which means that we're putting ourselves in a position where we're going to decrease our dependency on the market. Because right now we currently are at 33, which means every dollar the market moves up, we should expect to see about a $33 rise in the value. And the other way, if the market were to drop $10 overnight, we should see a $330 drop. Now, it doesn't really happen like that. It's not like clockwork. All these metrics are here, of course, to help you understand like sort of a fuller picture of what your portfolio has and what your specific option positions have. In this case, we've got these two options we're looking at. They're telling us the market value of them, the bid-ask spread, but also what's the delta for them for this stock, what's the gamma for this stock, and so on. These roll up into an entire book. Right now we have no position, but we're looking to add this bearish position. And then if we have this bearish position, we can then take the sum of our delta or of our gamma and use some math along with the correlation and the relative pricing of the S&P versus this stock and tell us what the contribution for this stock's delta and gamma is towards the overall book. And in this case, since it's a new position, the entire thing is a change. But these numbers here, these market value changes, these beta changes are exactly the impact they're going to have on the overall portfolio. And so as the market continues to move up, it could continue to surge forward, but we feel that if we enter this bearish position on this stock that we anticipate won't be surging upward. And again, we could be wrong on this, but all the indicators right now, including the market pricing, seem to be saying that this stock should be expected to be more likely to decline and is probably more vulnerable to a market drop than other stocks would be that don't have the current baggage that this one's carrying. So all that being said, let's take a look at what we've got from a trade point of view. So in our trade ticket, we'll get pre-populated with the pricing, and we see that the net credit is, we can try to get ourselves, let's say we'll ask for 91 cents. We'll probably come into the midpoint if we can fill it there. For now, the order proceeds 364. It's going to require $800 in margin. That's because we've got 4 contracts, each spread out by $2. And then sorry about that, 4 contracts, $2, yes, $800 for the margin, meaning that our estimated total cost, so the cash change for us is going to be $436. So we're putting 800 in the margin, we're collecting 364, therefore our total quote unquote cost is that they're going to take out of our cash balance and put this into margin, a net of that from what we hold now. So unless the pricing's moved around, we'll submit that order, and we're going to let that sit, and we'll see what happens. Now, I wanted to step out for a second and talk about some of the earnings trades we were looking at. And I had some questions come in that were pretty good. I'm just going to take Yelp here. We're not actually going to trade this, but we talked all about earnings calendar straddles and spreads and stuff. And there's a feature that I hadn't really been using on camera that I think is useful to understand. And that is, let's pretend we're going to go ahead with our earnings trade, and we're going to do a calendar straddle where we take Yelp's this week for earnings, and we're going to go at the money at, let's say we'll go 39, and we're going to short a straddle, and we're going to throw that in the Yelp book, and we're going to back up to the previous trade. Now we're looking at the short straddle trade for the 15th again. I'm going to move out a week to the 22nd, and this is kind of a neat way if you want to see what a given trade looks like at different expirations. You can easily hop back and forth. It remembers all the other stuff. I'm going to invert the trade, so we have a long straddle we're looking at now, and I'm going to model that in the book. And I've done this a bunch of times now, so I think everyone kind of follows along. But the net of it is, when this trade loads, we have, this short straddle and a long straddle covering it. It's a delta neutral trade. It's gamma neutral, pretty much. And then it's all about theta, and it's about burning off that short-term value. Now, this is the default P&L view. Now, the thing about this view, and we're going to clean up the UI a little bit. We've got some plans that we haven't pushed out yet, but I wanted to illustrate something pretty important, is that the volatility used by default at the current state of our software, and this is marked February 13th, 2019, is that we use the current volatility of options, the current implied volatility of options, to price what they will be worth in the future. So right now there's an earnings announcement between now and this date. But these options, which currently have a volatility of whatever it happens to be, it's probably in the neighborhood of 70s or so. Maybe the current ones are probably like 150 for this week. Then there's probably about 75 for next week's options. So these are being priced where this week's options approach zero because they expire on this date, and you close them out for the intrinsic value or some liquidity. Plus, we retain the value of next week's options using this 75% volatility. But that's not at all realistic. They're not going to retain 75 implied volatility. And so that's where our volatility adjustment comes in. The volatility adjustment models all the crushes that all the options you'll hold on this target date will be at based on the implied surface. So this will actually infer from the volatility surface right now and give you an idea. This is a much more realistic P&L for this, meaning that in the event you don't have any movement in the underlying stock, we will see the best return at that $39 strike price. And the reason for that is because this is the peak time value that will remain for both the put and the call we have for next week. Now, of course, the time value for the put and the call we're short this week, those go to zero. But next week's, this will be the peak amount that's left over. Now, if we didn't model for the volatility, we didn't have this automatic adjustment, you would see that the return could be suggested to be as high as $420 or so. However, if we do go in and we model for the volatility, you'll see that this crushes down pretty hard, and it's not even $200. This is a much, much more realistic view. Now, we have this interim user experience right now where you can override the exit implied volatility. What that means is, what implied volatility would you want to use for the options that you're holding on to? Now, this is a hard volatility, meaning that it doesn't do any of the adjustment here. In fact, this is sort of it's untouched. It's overriding the adjustment work and using this number here. We're going to combine this UI with this UI and give you three options for exit volatility. One's going to be use the current option volatility, which is fine when you don't have earnings or other crush events. We'll have a second one, which is our inferred volatility from the surface, which will be the one we recommend you use more often. And then we'll have this one where you can say, hey, I want to override that. Everything's trading at 20 vol now. I think it's going to be 15 vol, and you'll be able to plug that in. But as you can see, the adjustment that we inferred here shows that the market is pricing this based on the surface for these options to have an at-the-money volatility of around 51%, and it drastically reduces the return potential. Now you can come in here and say, I think it's going to crush even lower. You can say, I think it's going to go to 40. And then if you think it's going to crush to 40, you can see this number came down even further down. And you can also do the same thing for interest, for what it's worth. Right now we're looking at 2.5. This is a different kind of play. It doesn't really impact earnings as much. But this is a much more realistic view here than if we were to not override it, infer it from the surface, and not use the adjustment. This looks like a home run. And this was something I was trying to articulate earlier on in the past videos, that this was not a realistic number. Now, if you're a bit of a gambler, and let's say we go to this 51 or 52 vol, you can still do very well on this trade even as it moves up, but it's going to involve a bunch of management of a trade like this, because assuming you get movement that crosses the threshold of your break-evens, then the options you're holding, the net position for the credit at this point, is going to be equal to the debit you use to trade. However, you can then start to do interesting things, because if it moves up this way, that's an indication that that stock is bullish. Now, if it went from the $39 a share here up to, let's say, a 10% rise, which is still pretty substantial. In fact, this is a trade I would even consider entering today, because I think Yelp is probably less likely to move 10% up or down. As we can see, that's basically the mark, is 7.5% down, about 10% up. I think they're less than likely to move that, so there probably is a good amount of money to make here. But if they did exceed that and you found yourself to be in trouble because they went up 20%, well, what you can do is you can then take that short one that you're open tomorrow, and you can roll that short one up to somewhere much closer to the money, and it's going to be covered at that point. What you're doing is you're locking in the loss on the option you open today, but you're sort of doubling down on the time value by getting this option that you had here, and then you're moving it up here. And then at that point, potentially the amount of time value you're selling here, with the expectation that a stock doesn't go up 20% and then drop down 10% the next day, if you assume there's a reason that momentum's in play, you can actually kind of do a little bit of post-trade adjustment. And if we take a look specifically at this trade, we can see this market pricing is $40, which means it's about 40 cents. If you did some finagling and you were able to get yourself in at this midpoint of 15 cents a share, then for that trade, if it worked completely against you, you'd still potentially be able to come in, and if you could trade up and then sell this call after it moved up to net in excess of 15 cents of time value, and it kept moving up, you would then be able to break even on the trade overall. So we're not going to trade that here today. We're going to keep it in mind potentially for the future, but I wanted to just kind of call that out as a potential thing to keep in mind, because understanding how to use our volatility modeling is a very helpful feature. I'm going to move our trade down for Teva down to 87 at the midpoint. Actually, I'm greedy. I'll try for 88. I do want to close this out for sure before we leave today, and just get this on the books. We'll follow it all the way down to 87 if we need to, and hopefully we don't have to close it much below there. As you can see, the fact that we're getting less credit for it is a combination of the liquidity starting to get a little wider, and also the stock not showing much, it's sort of going in the direction that we have. When the pricing gets worse for opening a trade, it means that it's starting to move in the direction that you want it to move in when you're trading directionally. And so 86, I would imagine, should fill for us pretty comfortably. And we'll give that a second. If we go out to the portfolio, I have a feeling that within a couple seconds, there we go, immediately popped up here. So now we're in the Greeks view already, we're in the options view. Let's go to the Greeks, and we can see that we are now looking at a beta weighted delta of under 30, which I feel better about, and our gamma is a little bit negative. So in the event we started to see a continued market rise, this should drive this down. So I feel pretty good about where we are. And also our overall portfolio value, it is creeping upward, which is nice. We started the month, I think we're up about 0.5% on the month right now, which is good. And we're just trying to net, frankly, 1% per month until we get a feeling to get a little more aggressive. But for the time being, we're pretty happy with the positions we're in. And I'm gonna seal it off right there. If you have any questions, hit us up at hello@quantcha.com or leave us a comment below. And as always, good luck and good hunting.